And now I'm here with Chris Peacock. He is the founder and CEO of Aquaoso. I've called him the waterpreneur. He is an entrepreneur, serial entrepreneur. Started, 4 business, a couple around water. Current business is Aquaoso. And you also just got back from an accelerator program with Techstars, so a lot to cover. Why don't we get to know you a little bit first? Let's find out about you, your background, and what is Aquaoso.
Yeah, for sure. Great to be here, Mark. Thanks for having me. I've been working in the water sector for about 20 years. Started out totally by accident. Grew up in a family business of land developers and housing development. Graduated college, never wanted to go back and work for the family. So, of course, I took over the business when I graduated college.
Well, somebody's got to do it, huh?
Someone had to do it. Ran it for a few years, sold it to a national home builder.
Wow.
But in the process, we'd acquired a 70-acre piece of historical agricultural land in Arizona. And when we were trying to figure out what to do next with the property, we'd carved it up into 5-acre lots. And I realized there were these water rights associated with it. So that got me into the space around water, learned all about water rights and water markets.
Arizona, compare that to California in terms of desperation for water.
Oh, totally different, yet some similarities. So
Okay.
the biggest difference in Arizona at the time was groundwater was already being regulated, unlike here in California where we just started regulating the groundwater resources.
Okay, so you developed the properties and you found a way to figure it out.
I found a way to figure it out. Yeah, so my first business was a water rights management company where I basically was brokering, buying, selling water rights.
Interesting.
Did that for a few years, got married and had a baby, and decided babies were expensive, so I got a real job with health insurance and moved to Phoenix.
Okay, so what prompted the idea of Aquaoso? What problem did you really see?
Yeah, after spending about 18 years in the water sector, working with technology and data, and then the new rules here in California around groundwater management, I realized there was a really interesting opportunity to help better manage decisions at the watershed level by leveraging data. So that was really the foray into starting Aquaoso back in December of 2016.
Okay, so leveraging data, describe what that looks like in terms of your business.
Yeah, so today at Aquaoso, we're helping organizations understand the financial impacts of water-related risks on their operations. So we take public data sets, private data sets, we geospatially map them, we mash them all together, we put analytics on the top. And today we're primarily helping agricultural lenders, so banks, help farmers with their loans. So they use our tools to help underwrite their lending activities.
Gotcha. So a banker wants to loan money on this piece of land. Hey, we got to better make sure it's got some water on it. You push a parcel number and something happens. It puts up all the details that have been pulled up around that property.
Yeah, it's like magic.
Is that artificial intelligence?
Oh man, not quite.
Okay.
It's just really good data management at this point, but all geospatially mapped. So it literally is our customers go into a software platform, they type in an owner name or a parcel number, and we automatically generate reports with all of the land and the water assets related to that particular piece of property.
So who's the major customer? Is it a big bank, small bank, or maybe a guy that just buys and sells land?
Yeah, most of our customers are banks here in California.
Okay.
So a combination of large banks, so the commercial side, half the farm credits here in California are our customers. And then we have a lot of small community banks as well that use our software.
Okay.
So about 70% of our customers are on the banking side, and then 30% are large growers or agricultural investors.
Is the information that you're giving them or getting them, are you making it easier for them to get it, or is that information impossible to get?
So a lot of the information that we provide is nearly impossible to get.
Okay.
We're making it easy to get some of the information that they already have access to by aggregating it in one place, but we're also providing them insights and information that they've never had access to before now.
How different is your product from something else that might be on the market?
Yeah, that's the great thing about what we're doing. There's nothing else on the market today similar to what we're doing.
Wow.
A lot of our customers historically have relied on consultants to do a lot of this work. And
Okay.
we love consultants. I spent a lot of my time, a lot of my years working in the consulting industry, but it's not efficient, and you don't always get all of the data you need in real time. Versus a software platform like us, it's point and click and get the data automatically.
And how big's the opportunity? Realistically, there's a lot of land, but is it a worldwide type of opportunity?
Yeah, we're building a platform that'll ultimately expand worldwide. So just to put it a bit in perspective, if you think about the 7-year drought that we had in California, farmers lost about $2 billion in revenue opportunities, which had impacts on the financial institutions, on the banks. Worldwide, those same water risks that we're tracking around degrading water quality and extreme weather events, it's about $450 plus billion of revenue that would be lost across the supply chain of food. So it's a pretty massive opportunity to help organizations understand the impacts of these risks.
And so what stage are you in this company? How would you describe it in terms of, are you in the first inning, the early innings, mid?
Yeah, we're in the really early innings. We found product market fit with the technology. We commercially launched our software last September. So we pretty much had nothing going on last September, and now we've got about 26 enterprise customers, which represents a pretty solid annual recurring revenue number. We've raised a little bit of capital to grow the business. We've got 6 full-time employees. We started out focused here in California, and excitingly, we're now expanding into 5 new states.
Wow. Okay, so let's talk about the big obstacles, because I know many times early stage companies run into challenges. Talk to us about this early part of the game.
Yeah, we've never had any challenges in the startup, none whatsoever. No, we've actually pivoted the company a couple of times. So for those who aren't aware of what a pivot is, we're not talking about a center pivot on an agricultural piece of land, but actually changing the business model.
Okay.
So we originally started the business around water markets, the buying, selling, trading, and automation of those trades here in California, but the business model was fundamentally broken. So our biggest first challenge was what kind of business can we build that's sustainable, that has a large market opportunity.
When you saw that, the pivot, what led to the scrapping of the old thing, and what was the emotion around the pivot? Because I've seen a lot of people pivot, and these are tough things. You're kind of giving up your baby to a certain extent, and you've got Did it just roll off the back, water under the bridge, or was it agonizing to pivot?
There was definitely a bit of agony around it. We spent 1.5 years building some software and some technology, and we actually had some customers, none of whom had paid us anything, so that part was a little bit easier to relinquish.
And then now you're going to start, a new risk, right? Now you're going to start something new, and it's like, oh man, it's almost not. You had information, you had learned a lot, but you're starting over at some level, right?
Yeah, we started over in a lot of ways.
Okay.
Our customer base fundamentally changed. We weren't selling to farmers anymore. We were selling to banks. But the instigating event was a bank that we were talking to, and they kept asking us, can you help us understand water risk in our agricultural lending operations? So that was really the motivation for us to change directions and make the pivot in the company, because we realized they weren't the only ones having that problem.
Is there a nugget of wisdom there where you could think of that maybe, hey, if I would have learned this earlier, here's how I may have learned it earlier, that, our audience could take away okay, great. I think a lot of early stage companies struggle and don't know when to sort of scrap the old plan and pivot to the new. The discovery came from your customer, which is not surprising to me. Or came by listening to a customer.
I think that is the key piece of advice, is always be on the lookout for those nuggets by listening to the customers and asking open-ended questions. They had asked us questions, and if we had kept pushing on our other product, we would have completely missed the opportunity.
What did you ask? Do you remember what you asked that sort of led to this? Was it aha, or was it, I've been thinking about that one for a while?
No, it really was. We were trying to get an understanding from them of whether or not we could leverage their customer base to sell water rights to.
Okay.
To buy and sell water transactions, and see if we could get in front of some of their customers on the lending side, just to short circuit getting in front of the borrowers. Yeah. And they're like, yeah, that's kind of interesting, but we don't understand what's really going on here in California on the waterfront. Can you help us understand that? And so we just asked follow-up questions like, well, what does that really mean? What don't you understand? And finally, it came out that we don't understand the risk associated with water and our loans. Can you help us figure that out?
And you're like, yeah, I can
actually,
get that data.
Yeah. So what I will say is we didn't jump into it immediately. We spent 6 months talking to other banks and others in the industry before committing to making the pivot, because we wanted to make sure that there really was a market there before we spent a bunch of money on developing technology.
Okay. And one of the things that early stage companies tend to do, or at least consider, especially the ones that are going to raise money and really, fly to the moon, right? The high flyers, I suppose, they consider things like accelerators and incubators and things like that. And you recently got back from an accelerator. Would you mind sharing the story with us a little bit?
Yeah, absolutely. Okay. So we just wrapped up 3 months in Denver. Half the team moved to Denver for 3 months. We participated in the Techstars Accelerator program, and it was in partnership with the Nature Conservancy. So the entire accelerator program was focused around sustainability. So I was in a cohort with 9 other just amazing customer companies.
Okay, so that's interesting. Things. So it's the name of the accelerator is Techstars, right?
Correct.
Okay, and they're a worldwide organization, and they're breaking up their accelerator based upon industry type.
Yeah.
So yours, okay.
So ours was focused on sustainability. Mm-hmm. We were based in Denver. They have ongoing accelerator programs all around the world now. They're probably one of the largest. They're also one of the hardest to get into. They liken it to less than 1 or 2% acceptance rate.
How did you get in? What do you think? Why were you a good fit?
So first, we had a compelling story. We have been incredibly cash efficient. We've bootstrapped the business pretty much up until the point we got into the accelerator program, when we took on a little bit of extra cash to continue growing the business. So I think our story was compelling. The work that we were doing in water was definitely interesting to them. And the way in which I think we've been building our business and the focus on the financial side of solving the problem was really interesting. So they saw in us an opportunity where we could expand pretty aggressively.
Okay.
Yeah.
So they're looking for companies that are most likely to succeed. Basically, they want companies that, with a little bit of their help, are going to do something. And then, if you don't mind sharing can you share their model? So you go through what they do. All this. What for you they help you to become a stronger entrepreneur, build out your business strategies, and then maybe walk us through that. And then do you have to give up something for that? Do you have to pay in some way?
Yeah, so we had to pay in the form of equity. Mm-hmm. They actually made an investment in us as well, which is fantastic. So we got a little bit of cash out of the deal. We shared in some equity with them to help go through the program. But really their focus is how do you accelerate growing the business. So there was a lot of just foundational basics of putting the infrastructure in place to be able to accelerate at a rapid pace. Mm-hmm. So there were a lot of models that we were able to put in place, a lot of financial reviews, a lot of strategic discussions. But more than anything, the Techstars is especially well known for is their give first mentality, which means they have a huge network of mentors. The first month of the program was what they call Mentor Madness. And it literally was. We had meetings with about 80 different mentors in the first probably 3.5 weeks while we were there.
Wow, that's like a total immersion in other people's information.
Yeah, we were living and breathing input and ideas, and we couldn't synthesize it fast enough.
I can only imagine because, give me an example of one of the mentors, because I'm guessing finding somebody in exactly your space probably is pretty unlikely, but there are people that have a general background in business or maybe success in entrepreneurship that you found a way to apply it.
Yeah, so of the 80 mentors, we actually had 5 that ended up being our mentors throughout the entire program. So one of our mentors is a former CEO who's raised $60-70 billion, went through an IPO. Just fantastic insight in terms of how do you build a business, how do you build the team, how do you keep everybody aligned together. We had some great marketing help from some of the mentors as well. And we even had someone on the tech side, former CTO of a fairly large company, helping us on the technology piece. So it really was about them helping us where we were and helping guide us through some of the challenges so we didn't have to stub our own toes.
Is there any, self-discovery in those type of things where you go through and you're getting trained like, oh, I'm really weak here or I'm really strong there? Is there...
Yeah.
What did you discover about the business?
Yeah, for sure. One of the on the first day of the program, one of our program managers said, "Look, we're going to rattle the business. Some screws are going to come loose. You're going to see some hairline fractures. Some things might fundamentally break in the business, and we would rather it break now so that we can fix it before it breaks when you're scaling up." So there's a lot of intensity around the accelerator program, very intently, to see where things need to be fixed and what could otherwise be broken. And as an individual, as a person going through the program, there's there was a lot of growth for me personally and for the rest of the team.
Mm-hmm. So was there any focus on, you said the rest of the team and you, so you had 3 people. Is that half your team? Is that what it is?
So we actually, at one point we had 4 people there.
So are you on the same track as the others in terms of learning? Because you're the CEO of the company. Are you taking in the information simultaneous with your team, or are you on your separate, hey, I got this guy on the CEO leadership track?
Yeah, so for the most part, we were taking it all in as a team.
Okay.
So from a team cohesion standpoint, it was amazing.
Okay.
We really got to bond a lot going through the
you're in
program.
you guys used to go to Denver, fun place to go, but then you're going through this boot camp of sorts that you immerse yourselves in each other's world.
Yeah,
you
we
probably
were living
learned all
together.
the
We were
bad
all in the
habits.
same apartment.
Oh, you guys are in the same apartment
we
too?
were, yeah.
Oh, wow. Okay.
Yeah, so it was pretty cool. There were a few times that I would do some one-off stuff with the other CEOs. So one of the valuable pieces for me was we had a CEO forum. So of all of the 10 companies, the CEOs would get together every week and be able to talk about CEO stuff, like how hard it is sometimes to be a CEO, the loneliness that comes with it at times, but also sharing ideas and ways in which to accelerate each other's business.
What did you learn about yourself as a CEO? I mean, you comparing yourselves to other early stage companies, and obviously you're being mentored by people who have been there, done that. Any self-discovery?
Ton of self-discovery for me. I know my team members had self-discovery too. I would say one of the things I was really impressed with this accelerator program is I also had some executive coaches that were assigned to each of the CEOs throughout the entire program. So it wasn't just the business bootcamp side, but it was also the how do you take care of yourself as a CEO? How do you find the time to sleep, to eat, to work out, to do those things that you need to do to be healthy as an individual? So for me, I found I actually had a lot of strengths that I probably wasn't giving myself credit for. As a team, we've mostly been self-deprecating, probably more than we should be, and not taking, not really celebrating the wins when we've had them. That was one of the biggest lessons for us, was celebrate the wins more often rather than moving on to the next thing.
Well, it's an interesting thing. So one of the biggest decisions, I think the biggest decision for a CEO to make is how to allocate their resources, right? Starting with your time. And a lot of us, we work in our business, maybe too much, right? We spend the majority of our time working in our business, and then we take a very small percentage of our time, we step back and we work, call it on our business. And so this one to me, so I guess this was a high percentage of your time working on the business. You think you're allocated your time wisely? I mean, at this early stage in terms of, somebody might criticize you, an investor might criticize you of like, dude, let's go grow let's go grow now. Where's the customers? You guys are immersed in, training when we need to grow the company. I may have even heard somebody imply that offhandedly. So thoughts on that? Or you still agree with the decision?
Yeah, I do still agree with the decision. It was a big decision to make, right? You're taking a few people out of the company for 3 months. You're giving up a little bit of equity in exchange for this program. Like it was a huge commitment. And I wasn't the only CEO that struggled with that. I think most of the CEOs in the cohort had to go through some sort of a process.
Yeah. Did you have to, how did you wean yourself? So you're like a lot of us, I don't know if you're this way, but I'm in my business a lot. I'm a dreamer, so I'm kind of on the business a little bit, but I'm real time on emails. I'm super responsive, even though I'm like super busy. And I'm almost addicted to the, 24/7 thing. Yeah. Well, here you are sequestered. You're supposed to be focusing on your studies, young man, right? So like the decision to like shut it off, was that hard?
It was really hard.
I assume you had to shut it off at some level.
At some level we shut it off, but we still had half the team still working in the business and growing the business and working on technology and doing sales. And we certainly had we had some interesting discussions around, why aren't we accelerating this piece of the business? What are you doing there in the program working on the business? We already know the model. But fundamentally, when I look back on it, it was definitely the right decision. Like the entire team is stronger and smarter because of what we've been able to do. So we may have had to take a few steps back in time to work on the business, but I think we're working a lot smarter now in terms of moving forward. So a lot of the program was, how do you start accelerating the business? And I truly do believe we had 12 months of learnings in that 3-month window. And now we're starting to apply that to the business, and we're seeing things go faster than they would have in the past.
Interesting. So, I mean, Would you say that a Techstars or an accelerator is, if you can get in, is the right move for an early stage business on any front, or are there some people that really aren't cut out for the accelerator?
Yeah, I don't think it's for everyone or for every business. This is my fourth business. This is the only one that would make sense to actually go through an accelerator program.
Okay. Why? What's so who is it? You had the other were more of consulting businesses.
They were more consulting businesses, so revenue models were very different. You're selling billable hours. I think there's programs that are better attuned for that kind of a business. But when you're in a high growth startup like we are, building a software as a service company, and it's all technology based.
Right.
There's a lot of nuances in terms of how you can build that business and the levers you can pull in the business.
So it has a lot to do with the scalability of the company, the potential scalability of the company. Is like, if this thing can go, if it might be a rocket ship, it'd be worth having the foundation strong. Otherwise, go drive some revenue and pay the bills and so on.
Yeah, absolutely. Okay. And again, I think your heart also has to be in the program and doing it. I could see some people who maybe wouldn't want to be in the program, and they wouldn't get as much out of it. I think it's like anything. You get out of the program whatever it is you put into it.
You think some people wouldn't be as open to it because they're just not as coachable people, right? They're not really accepting of new data in terms of, I know what I'm going to do. I don't need to be told, right? So, I want your investment, Mr. Techstars, but look, I know what I'm going to do. Don't coach me.
Yeah, and I think coachability is a huge element that Techstars and some of the other accelerator programs look at. Is this team coachable or not? Are they willing to listen? Are they willing to learn, more importantly, and then take those learnings back into the business?
So thinking about this, so now you're back. You were in Denver, so now you're back here in Sacramento, in the Sacramento region. What's the plan? Can you grow this thing from within Sacramento? I mean, this is a big opportunity. You're already expanding into other states, but can the heart of it be here in the Sacramento region, or do you really need to put satellite people all over the world?
I think we can build a lot here in Sacramento. As we've been thinking about our expansion and how we build the business and moving to other states, we're going to be looking for experts in some of those other states. I'm still a little concerned here in Sacramento with the talent pool. I think there's really great individuals here, and I think we can get to the next milestone or two with talent here in Sacramento. But as we start building a larger business, that's something that I'm still looking at as a CEO of where are we going to find the talent, and then how do we build out the team? Whether it's a distributed team in the longer term, or do we have everybody in the same location?
What kind of talent is going to be like the stuff you really need to add? What's missing from the team?
Yeah, so I think our success so far has really come from having a cross-functional team, right? Like, I've got 20 years in water. My co-founder is a third-generation farmer. We have 2 water attorneys on the team. We've got 2 really amazing programmers on the team. So, as we think about growing the business, at least in the immediate future, we're looking at tech talent and sales talent. Those are the 2 main drivers for us.
Yeah.
And then we'll start pooling in other talent. So as we move to other states and we start getting more nuanced on the various water laws and rules and regulations, we'll probably be looking for some talent on the water policy side as well from those new geographies.
So in scaling the business, obviously one of the big obstacles is building right team, getting that talent. Scaling fast requires capital. Typically, you can raise the money from your customers, selling stuff, making a profit. But if the window is tight enough, like, hey, this opportunity is now, then I'm an investor into your company. I think it's fair we should disclose that. But how do you view the future capital needs for a company like this, a startup company? That's on the software side, how much capital is that? How capital constrained will you be?
Yeah, that's a really great question. And that was a lot of the modeling that we did while we were going through the Techstars program and making the decisions of, do we continue to self-fund? Do we raise capital? When do we raise capital? How much do we raise from a capital perspective? And so we got some really good feedback and built some really amazing models around how we go build the business moving forward. So we know we need capital to expand. We could bootstrap the business into perpetuity. It won't become the big monster that we really want it to become. Yeah. And what we realized, and this was a really interesting element for me as the CEO around bootstrapping versus raising money. We realized that if we chose to bootstrap, we wouldn't be doing ourselves as founders a good service. We would be doing ourselves a disservice by not growing the business into what it can ultimately become. So we thought long and hard about how we build the business and where do we give up equity and when.
What can it become? What can a company like this become?
Yeah, so we can see us becoming a $50-60 million a year business over the next 5 to 6 years, which is all annual recurring revenue on the software side.
Right.
It's a lot of work.
So
that
these
goes into
are
building
high
that.
margin. This is high margin revenue because once you've made the sale, so you go out and have a business development team, you make the sale, you get the bank or landowner on board paying the monthly annual fee or whatever it is. You can basically decrease the amount of money on new business development, and it's all straight to the bottom line.
Yeah, that's correct. On the software side of the business, you're talking 65 to 75% profit margins at the end of the day.
Wow. Okay, so let's talk. So a lot of times when I'm talking to people about raising money, and there's people ask me for advice occasionally on how much money do I raise, right? So you went to some professional training on how to think about the size of your next raise and so on. So it kind of makes me think. I often tell people, hey, you need to get 18 months of runway, that type of thing. Enough time to make it easily to your next raise, so you don't. The last thing you want to do is run out of money in the middle of a software development project or something like that. Or I want to hire these 5 sales reps, and now I'm stuck. I can't even hire these people because the cash just doesn't support it. So how do they talk to you about that? What are your thoughts on that?
Yeah, I've finally come up with my own philosophy around the financial side and the fundraising side. So I'm not one of those guys who's really comfortable getting too far away from profitability or cash flow break even. I don't personally want to see the company be more than 2 rounds away from being able to get to cash flow break even. So the way that we've been building out the models and the growth path is we can hit major milestones, 3x revenue over the next 12 months. But at the same time, be able to turn on cash flow break even positive at the end of each round so that we have optionality in terms of when we raise money and whether we want to raise money or not.
So hover around the break even, or if your burn rate, just keep it very controllable. Okay, do you, in terms of controlling that burn rate, sometimes I recommend to people that they use outsourced partners, right? Use somebody so you can they can sort of scale with you versus hire the in-house attorney. Let's outsource it. Hire the HR professional as a consultant or on a retainer of some kind versus, hey, go out and hire a top-notch HR person.
I'm a huge fan of the outsourced model.
Okay.
I truly believe that if you have core competencies, you should bring them in-house. So for us, technology development is a core competency. So anything core to what we're building, we will bring in-house.
Okay.
If there's some mobile app or some other component that's not core to what we need to do, we can outsource some of that.
Yeah.
And I don't see us needing full-time HR or accounting or CFO level help for a while. We can get fairly large leveraging all of the resources that are around us here in Sacramento and elsewhere.
Yeah, exciting stuff. So thinking about, do you care if I ask you a little more about the capital raise and all that kind of stuff? Because I think people are interested in that. I mean, it seems like, so I have these things here in my office called Hanging with Haney. You haven't been to one, but I'll kind of bring entrepreneurs in and kind of share our big dreams, talk about our fears and doubts, and then maybe the obstacles. It's kind of like a confidential hangout with other entrepreneurs. They're kind of fun. But a lot of times, people are sort of wrestling with the raise money issue. Everybody, that's like one of the hottest topics is, Mark, how do I get angel investment? How do I get VC? I mean, any thoughts on that in terms of, you just got yourself immersed in that, somewhat in that world.
Yep.
Any thoughts, any takeaways from Techstars?
Oh, for sure. And having gone through it a few times, I think you can make it as painful as it could possibly be. Or you can simplify it in some ways.
Okay,
And so,
tell me about that.
So what I've learned on the simplification, run it like a process, run it like a sales process, run the raise in a very organized rather than haphazard manner. And I think the natural tendency is reach out to whoever we possibly can, kind of scribble some notes down, keep following up with people. But if you do it in a much more organized way as you would a sales process of have a pipeline of investors, put them in various stages, have the right conversations at the right time. I think one of the tricky things on the financial capital raise part is getting investors to move at the same speed. And sometimes you actually have to slow some investors down because what you want at the end of the day is everyone coming to agreement on what terms are going to be around the same time frame.
Okay.
Which I think there's a bit of art to that as well, and a bit of practice. But I think the biggest piece of advice that I got was just ask. If you ask for money, you're going to get advice. But if you ask for advice, you might get some money.
Ask for advice. Okay,
for advice.
Ask for advice. I have heard that somewhere before. I think that's an interesting mantra, I suppose. So you have got your seed round done. How do you classify these investment rounds at this stage for you? Is this a seed round that you just did with Techstars? Pre-seed? What is it?
That'd be pre-seed.
Okay.
What we'd be doing now would be more of a series seed
Okay.
round. What would have been a series A round 5-10 years ago.
Right. So today that's a pre-seed round. And then, what do you anticipate for upcoming? Do you mind if I ask you these questions?
Yeah, no,
okay.
not at all.
Yeah,
We're back in market. So
Okay.
we decided that right after Techstars, we would go back out to market and start having conversations. We had
Interesting.
really great leads on the investors side. So we had a demo day as part of the Accelerator program.
And describe to our audience what's a demo day?
Yeah, so for us, demo day was each company had the opportunity to do a 5-minute pitch in front of a fairly large audience. Techstars demo days are a bit different than some other demo days in that we spend about a month preparing for that one 5-minute pitch.
Is that just for that 5-minute pitch, or is that to sort of strengthen you for the future?
It feels like it's for that 5-minute pitch, but it really strengthens you for the future, for all of the future conversations.
Interesting.
Because it creates a steel thread across all conversations about what is the business you're in, how do you make money, how do you grow the business, what is the type of talent that you're looking for? All of those components go into that pitch. But this one was really special because it was with the Nature Conservancy. There were also a lot of really great discussions around sustainability, and the Nature Conservancy was involved in the demo day as well. So it's kind of the final celebration of making it through the program. And for us, we had about 750 people show up in Denver live to our demo day, and it was absolutely amazing. Yeah, it was incredible.
So what's the feeling? You were getting ready to walk up to the mic, I suppose, and do your presentation. Is it nerves, or you're comfortable speaking, obviously, but that's a lot of people.
It's a lot of people, yeah. And when we first started thinking about it, just pure terror across most of the CEOs, right? Of shoot, do I have to remember this? And we don't have the clicker. We're not clicking, so we had to rely on our co-founders to actually work through the slides. So there was a lot of practicing involved of when do you move the slides versus when do you don't. So it was a really good bonding experience with my co-founder, Cameron, as we went through the process.
So Cameron helped with the pitch at some level. At least he was the technical guy with the slides.
Yeah, exactly. But on demo day, what was interesting is we had an investor morning that day. So I did that same pitch 5 different times in front of 5 different investor groups. Yeah. So by the time we went up on stage, I think I had practiced that pitch about 200 times.
Oh, wow.
Before ever going up on that stage.
Don't you feel like practicing is like that? It's worth it, isn't it?
It's totally worth it. Yeah, it's totally worth it. Although I will say I got to the point where I was waking myself up in the middle of the night, pitching in my sleep. And I realized, all right, it's time
I gotta shut it off
to move on.
That's great. Okay, so as you prepare for this next round, let's call it. Would this be the seed round?
This would be the seed round.
Okay, the seed round. How important? Thinking about who the investors are into a company. I mean, I think there's some investors that are probably more helpful than just the money. I have to assume that there might be a strategy around who you want on your cap table. How do you rationalize that?
Yeah, so for us with this round, the investors are just as important, if not more important, than the money they bring to the table. We know we can go find the money that we need, but what we're really looking for with this round are strategic investors who can help us grow the business and grow the team and really provide good input in terms of how we build the organization. And what I found is that's not as easy to find as it is maybe just the pure capital side. I think with the angel round that we did going into Techstars, we got really lucky. We've got really great investors that came on board who have been super helpful.
Yeah. So there's some guys that know sales, a little bit connected to a few banks and so on.
Absolutely. Yeah. And so I think we got a little bit spoiled because of that. So that's what we're looking for in the next round as well, are investors who can really move the needle on the business.
Interesting. So what would that look like? So I'm wondering in a business that's sort of B2B, You want something strategic. Is it someone who's super connected? I say this not for myself as much, just for the rest of our audience.
Yeah.
When they're going out there to raise money, do you want people that can help you find other capital or help you find customers? I mean, or help you find employee talent, or maybe give strategic advice?
Yeah, and I think that's important for anyone out there listening is understand the needs of your business at the time that you're raising the capital. So for us, we're looking right now for the strategic investors who can help introduce us to new customers, but not just in the banking sector. Some of the other areas that we're looking at on the insurance side or agricultural investing, or even the packer shippers. So we're looking for a little bit of a different
Packer shipper. What's the packer shipper?
So someone who's like packaging the almonds coming out of the Central Valley, who's interested in the risk associated with their growers.
Oh, interesting.
Yeah.
Okay.
So we're looking for those types of folks, but we're also looking for folks who can actually provide strategic advice as we build out our board of directors and think about how future financings are going to look and introduce us to additional capital when the time is right.
You bet. Okay, so thinking about this opportunity, right? So you build this business, you go through your seed capital. Your next would be your Series A. At the time, you're valuing your company higher and higher. I mean, did they talk about how companies ought to be valued? Because I mean, some people say there's more money on the to put at play than there are great companies to invest in, which means maybe you can cause yourself to be worth a little bit more because you're not getting valued on your cash flow. You're getting valued on the upside, right?
Yeah, you're getting valued on what you can ultimately become. And I think this also goes directly back to how much do you raise, because there is sometimes a sweet spot of how much can you raise and what can that do for you. So we actually went through the exercise of if someone offered us 2 times more than we're raising, what would we do with the capital and where does it move the numbers, if at all? And I think there's, part of the discussion that has to be had internally is, can we actually use all of that capital or not? And there's a big push in a lot of the VC community, especially, to try to take more money, which I personally don't think is healthy.
Okay, because if you're sitting money in the bank account unused, that's and you're giving up equity.
Yeah, it's expensive. It's expensive capital first, and if you can't deploy it, then you're really not using it to grow the business. Which means when you do need to go raise more money, if you need to, your valuation numbers might not be where they need to be, and you're going to take a down round of some sort.
That's the most expensive capital you're ever going to take is these early rounds. So if you take too much at a lower valuation, because the thing goes up when you get to your Series A or a B, the company's worth a heck of a lot more money.
Yep.
And so you can take a little more money in, right?
For sure.
So when you think about that, so dilution, I guess everybody's got this, personal barometer on how much of the company they want to give up.
Yep.
And you have a co-founder. Are you mainstream in that, or are you? Are some people are more like, I don't want to give up. I'm invested into one company, and they didn't want to give up any. They were battling on every front to retain equity. And I thought, boy, if we could just take on a few more strategic investors, this thing could go to the moon.
For sure.
And so, but how do you wrestle with that?
Yeah, so I think my philosophy around it really is, I don't look so much at the equity percentage anymore. I look at what is the value of what I currently own from a stock perspective. Because if I take on money, and I also don't look at it as giving up anything, we're selling equity. We are selling a piece of the business.
Yes.
So not giving up anything. I'm making very conscious decisions of selling equity to investors, either for the cash or for the strategic energy that they can bring to the company. And then the real question is, does that cash improve the value of what I already own in the company? And if not, then it's probably not a good idea to take the capital. But if it does, I think that's a healthier way to look at selling equity and raising money.
Interesting. I love it. So closing thoughts. We're thinking about the entrepreneurs out there. Here you are, somebody who's built this really cool company in the high-tech space. There are other people that never get to this level, right? There's a lot of stories of people who go out of their business on the way to the accelerator, right? Yeah. And then you make it through the accelerator, they still go. But you guys are already positioned in with the type of business that you have to sort of de-risk it, because you can cut to profitability at any time to survive. But to all those who want to get to this level, making it through the tougher times. Any advice to them?
Yeah, you got to put in the work. Like you got to do the work. You got to put in the time. You got to put in the effort. Like this isn't a 9-to-5 job, right? Being an entrepreneur in a startup, especially if you're taking outside capital, it's not a 9-to-5 job. It takes a lot of time. It takes a lot of effort. It takes a lot of energy. And I think that's my biggest piece of advice to anyone that wants to be an entrepreneur is understand what that really means to your life and to your family. Like my wife understood Chris is going to Denver for 3 months, and we had long conversations about what that ultimately meant for us and for the company. And so being able to put in the hard work, but also having the support system that can help you through the tough times.
Well, that makes me have a follow-up question. So, you said you take on the investment, and did that put more pressure on you think? Like, now it's more than, obviously you pressure to succeed for your family and your wife and all that, and for you but when other people start throwing in their money, they're betting on you. Did that change your perspective at all?
It didn't change it significantly. I was already feeling the pressure. It just kind of shifted where the pressure was maybe coming from. But at the same time, there was a bit of lightening as well of, look, there's people who are entrusting us. They believe in us. We should have the strategic confidence in ourselves as well that we can go do this. And, no matter how many hard things we get hit with, like, you just work your way through them at the end of the day. Like there's a grind associated with being an entrepreneur. And what we learned through Techstars in particular was how do you do the grind more smartly, if you will, and just become smarter at work and business.
Love it. Chris Peacock, founder and CEO of Aquaoso. What a story. It's just the beginning. Thanks for sharing it. And I'm sure we will have you back as you hit milestone after milestone. We want to continue to sort of track your progress especially as one of the entrepreneurs that I invested into. I'm lucky enough to be brought on, and just so proud to, I think today was a great example of the kind of decision maker I am when it comes to investing. So thanks a lot, Chris.
Yeah, thank you, Mark. I appreciate it.
You bet.
Thanks for watching today's show. My goal for every episode is that you find a takeaway, something tangible you can use in your business today. And if you have a comment about a favorite takeaway, feel free to put it in the box below. And if you have a topic that you'd like me to bring up on the show, don't forget to let me know. And also, don't forget to subscribe to our YouTube channel if you want to learn more about entrepreneurship. Because at Haney Biz, we are always by your side.